So if everybody's okay with that. Kirsten, did you get done with the piano?
I did, yeah. My last student showed up early, so I'm done.
Good. As we're recording this, we have some people that couldn't make it and they wanted it recorded, so that's but as far as the recording goes, we're recording just on what's on my screen, and so it's just Josh and I. You guys don't have to worry about having your face plastered all over things are being sent out. I mean, not that we'd care if it was Caitlin and Kirsten, but I don't know if we want to plaster Jason's all over. Not.
As long as you're paying me for advertising.
It's all good.
5% for every new customer. Okay.
All right. Sounds good. Sounds good to me. Well, guys, thanks for being here. We're going to actually do this, just so you know. We knew like the first time we do this, we wouldn't, we'd have a few, and figure it out. But we're going to do this every quarter. First month of every quarter. So the next one will be in April. So please share with friends, people getting into this, because I've been helping people finance their houses for 20 years now. And the funny thing is, I can be talking to somebody who's in their 50s, 60s, purchased 4 or 5 homes, and they still can't answer some of these questions, and so I think it's important, and Josh and I were discussing this, we think it's important that people know the things we're going to share, and some is going to be basic. And if you know those things, just be patient, because like I said, we're recording this, but there's just things that people need to know, because this is usually the biggest purchase anybody ever makes, when they buy a house. And I know at least you guys have thought about this, and it's tough right now. It's a lot tougher to do it now than it was even 5 years ago, because prices have gone up and interest rates have gone up. And when those two things rise at the same time, that can be a problem. But eventually, things will correct themselves, as far as, I'm not sure prices are going to come down anytime soon. We're not in 2007, we're not going to see another 2008 anytime soon, because that just isn't a thing. There's such thing as supply and demand, and that is the biggest economic principle out there. So let's just go on and we'll start talking about this stuff, and Josh will handle some, I'll handle some, and let's just go. Okay, this is just a little bit about us, and yes, I'm the one that wrote what it says under Josh's name. I might have all the experience and everything else, and but I have no problem saying that he's smarter than I am, which is the reason, you guys know, because you know us, that I have Elaine and I have 6 kids. Notice how only one works with me. That's all I'm gonna say. That's all I'm gonna say. Don't show that recording into your siblings.
I don't know if that means I'm the smart one or not. I don't know.
But one of the things you'll notice on here is that on the second line down there, it says that I'm a certified mortgage advisor. And you take a wild guess, guys, and I know you're on mute, but unmute yourself for a second if you have an answer. Take a wild guess on how many mortgage loan officers there are in the state of Utah.
I don't even know.
A lot.
It's over 5,000.
Oh my gosh.
Okay. Now take a wild guess on how many are actual registered certified mortgage advisors.
1,000.
Nope.
500.
Lower.
200.
I won't make a guess anymore. It's 20.
Oh my God.
There are 20 of us in the entire state. Okay. Now, does that mean that other loan officers don't know what they're talking about? No, it doesn't. There's a lot of good loan officers I know that are out there. What it does mean is that I've studied different aspects of the markets, rate locks, different things like that, I could talk about things that, technical aspects of the job that most can't, and how to fit that in. Also, my 6 years of experience in the finance industry, that was financial planning, helping people with that. And so that is something that I incorporated in the business as well. So I look at it as a whole approach to not just, hey, I'm just buying a house and everything else is separate. We'll look at other things in your financial, well-being to make sure you're getting the right loan, those types of things. And like I said, the reason Josh is learning all of that because that's how I look at this job. Okay. And look at this career. So, okay. So here's what we're going to talk about. Go ahead, Josh.
So the first thing is obviously, when you go to buy a house, you have to figure out what the lender's going to look at and what you need to present to them. The thing that what do we like to say? The underwriters of a lender are going to assume that you're a Cuban drug dealer and that all of your money is laundered, and you have to prove to them otherwise, right? That the money you make is legit, and you're a legit person. You're going to, be a law-abiding person and stuff like that. So you have to show them that you have solid credit, and debt to income is the other thing that we'll talk about. That's kind of what helps you decide what you can afford. We'll talk about that. And then, so we're calling it like the 3 C's.
So
or the
that's a D.
CDC, sorry.
The CDC.
It was the 3 C's. So the CDC of things that lenders look at.
We're not talking about diamonds here. There's 3
no.
C's of diamonds, but that's not what we're talking about here.
We had it as the 3 C's, then we changed it.
it.
Anyway. And then we'll look at the 4 common loan types, and what goes into them and how to qualify for them, and then the whole entire home buying process, just start to finish. It's not super complicated. There's just a few steps and stuff. But we'll just get a quick overview so that you kind of get a good synopsis of how it all works. So anyway.
All right. So some of the things, what goes in your credit score? One of the things that we want to talk about on this is some people know the basics of credit, but not the details. So if I were to ask you guys, and I want this to be a little bit interactive here, but I were to ask you, what is the most important thing? What's the biggest percentage when it comes to calculating your credit score? What's the most important thing?
So your utilization?
No, that's number 2. That's number 1. That's 30%.
Life credit history.
Like credit history,
Yeah, but what do you mean by that exactly?
like age of credit.
Age of credit.
No, that's actually not. That's one of them, though. But the most important thing is, do you pay your bills on time?
Oh
Oh,
yeah,
yeah.
100%.
That's 35% of it, right? Okay.
Yeah.
So some of the things you might have heard aren't completely accurate. And we're going to talk about some of those things. Okay. So Josh, let's look at this.
Yeah. So here it is. So yeah, 35% is your payment history. 30% is your utilization, and what you use. And then 15% is the length of your credit history, and then 10 and 10 for new credit, which is like credit inquiries when you get your credit pulled and stuff like that. And then your credit mix, and we'll kind of talk about those real quick. But first of all, the first one we'll talk about is amounts owed, and what kind of goes into that.
So when you look at the amounts owed and utilization, as you said, Caleb, what we're looking at, or what the credit bureaus are looking at, is what your credit limits are. And it can be installment like car loans and everything. They're going to look at what the original loan amount was and then what you owe on it. The most important thing that they look at, what affects your score the most, are credit cards, okay? Revolving credit, because there's a limit, and then they're going to look at what you use as far as the limit goes. You'll read in magazine articles all over the place that says keep that below 30%, okay? Well, I'm going to tell you that if you keep it below 30%, your credit score will be fine. But if you want the highest credit possible, okay, you want to keep below 10% and then even lower than that. I have looked at credit scores, like I said, for 20 years now. And I tell people to use what's called the Big Mac rule. Okay. Let's just say you have a credit card with a $1,000 limit. You want to keep that under 1%. So what do? Once a month, you go out and you make sure that even if you've paid off your entire bill, that you go out and buy yourself a Big Mac meal or something, don't try, you might find something better than that, but something around $10 to keep that credit, that amount that you owe, right at about 1% of every card you have. Okay. If you want to maximize. So if you're going in and saying, okay, within a few months, I want to buy a house or I want to buy a car, and you want the highest credit score possible, work your tail off so that you can get all your balances down to 1% of the limits on every card. Okay. And that will maximize. That will give you a higher score than even if you have 0 balances. Okay.
So just a question for you, Dave. So that's 1% on every single card that we have, right? It doesn't matter I guess I've always thought of it like, if you add all of my available credit together and I keep that under 10%, then we're good. But is
You-
it,
you
is
are.
it
You will
individual
be.
basis?
I will tell you, you'll be fine. But if you have some cards that you have zero balances on, and then you have one that's got a 10% or whatever, or one that's at 20%, and that evens out to like 10% across the board, just that balance, you would be better off having a 10% balance on each card than you would have 0 on one and 20% on the others. It doesn't say, it sounds totally counterintuitive, but a lot of things that you will see here are counterintuitive. One of the things if you would have listened to my grandmother, she would have said, pay off all your credit cards and cut them up and close your accounts, right? Well, she probably just dropped her credit score 60 points if you do that, And I will tell you this too. I love Dave Ramsey as far as paying off debt and putting money in savings. What I don't love is him telling people that they don't need a credit score to buy a house. Okay, you don't, but here's what's going to happen if you don't have one. They're going to, if you didn't have a credit score, I can actually have helped people with no credit scores buy homes. Okay, and what happens is we have to find 3 accounts that they have been paying on for at least 12 months, but don't report on credit reports, like their utilities, their cell phone, maybe whatever else you can, the rent. Okay, and then what happens is that we say, okay, we have established credit, so we're going to give you a credit score, and that credit score we're going to give you is 620, which means even if you have a great, you've paid all your bills off your whole life, or paid cash or whatever, we're probably not going to get you a conventional loan. You're probably stuck in an FHA loan, which is great to get going, but it's not what you want. And here's the funny thing too: as soon as you get that mortgage, what's going to happen? They're going to start reporting to a credit bureau, and you're going to end up with a credit score anyway. Better to have a good credit score in the 700 range and all that. So yes, can you get it? Can you get a mortgage with no credit score and everything? Yeah, you can. But you're going to get an FHA loan because that's the only loan that lenders will give without a credit score. You will not be able to get a conventional loan. We'll talk about those kind of things later. Okay, so
yep. So that's that one. Then the biggest part is payment history, right? Always paying your bills on time. And so the biggest thing with that is like just a tip is just setting up auto pay. Right, and making sure that those bills get paid automatically, because sometimes you forget, sometimes things happen, life happens, and even if you miss one payment and it's late, that can take a nice chunk out of your credit score.
when do they determine when a payment is late, Josh?
Well, normally that's another thing. It's like you think that once it's past due, like past due, like on your reportals have like a due date. If you pay after that, it's late, but it's still not technically late. So
not until till 30 days late.
Yeah.
They won't count on your credit report if it's due on the 1st of January and they have it in their hot little hands and they have actually posted your payment by the 31st of January. They won't be considered late on your credit report. It hits February 1. And there's a late, and you've just dropped your score 50, 60 points. Okay.
Sorry. And the next thing is, again, with new credit. I know that we hear this all the time with people when they come to apply for a mortgage. They're like, oh, well, I don't want you to pull my credit, or I went and talked to another lender and now I'm talking to you guys. Don't pull my credit. Like it's, and the things with credit bureaus is they know that people go out and they shop, they're shopping for a new credit card or a home, and sometimes that means getting your credit pulled a couple times from different places. But if they see that it's being pulled for the same reason, then there's a grace period, usually 30 to 45 days, that it's not going to negatively, you're not going to get like multiple hard inquiries on your report. They'll just count it as one, even if it's from different people for the same purpose, if that makes sense.
They'll show on your report as being pulled, but it only count as one against you.
Yeah.
So,
and really getting a hard inquiry, it's like, yeah, it can knock your score a little bit in that moment, but after a little bit, it goes away and the effects wear off pretty much. So it's not really a huge deal. So not something to really worry about too much. And the other thing is, again, don't close your old accounts. If you got a credit card that you have had a lot of, you racked up some debt on it, whatever you've done, you paid it off, don't close it, because you want to keep that age, because the average age of all your accounts is taken into account in your credit score. So someone who has, the same types of accounts, same number of credit cards, car loans, maybe they both have a mortgage, but one's been paying on them for 5 years, the other one's paying for 15 years. Person with a 15-year history is going to have a higher score, right? So they want to see that age and you consistently, having good solid credit history. So those are the couple tips for those for credit. And then we'll move on to debt to income. And yes, just like it sounds, it's a division problem. So it's super easy. So it's literally just your monthly debts, all of your debt obligations divided by your gross. It always goes off gross, your gross monthly income.
Before taxes, right?
Yeah.
So basically what we're talking about with monthly debts is they're the things that appear typically on a credit report. They're not going to calculate things like, your phone bill and utilities and those types of things in your debt to income ratio. Okay. So installment loans, cars, student loans, revolving credit, credit cards, collections, medical debt, that can come into play if there's a monthly, if the credit report shows that there's a monthly payment, but that typically doesn't. Okay. Those kind of things we just have to add up and see whether or not you have to take care of them and pay them beforehand. So basically anything that shows up on a credit report. So, and then also some that's court ordered, like alimony or child support that you have to pay. Those have to be calculated into your debt to income ratio.
Yeah.
Okay.
Cool. So here's just a quick example of how we calculate a debt to income. So say you've got your mortgage payment, right? It's $2,500, $250 car payment, $150 in student loan debt, and $45 in credit card month. So those are all the minimum payments every month.
That's important too, because people will tell me all the time, oh, my minimum payments, this on my credit card, but I make $200, if I pay $200 a month. Well, lender doesn't care. You can make that, or you can keep making that if you want, but they don't care.
They'll just go off the absolute minimum of your payment. So let's say you make $7,000 a month gross. This is always going off gross. So 2,945 in your monthly debt obligations divided by 7,000 is 42%. So looking at that, we'll talk about some debt to incomes of the regulations for your GTI for different loan types, because conventional, FHA, USDA, those things, they have different DTI ratios. But typically if you've got 42%, like that's pretty solid. So the next thing is the collateral that goes in, the other part that the lender will look at,
which is basically the house, right?
Yeah.
Whatever's pledged as security. That's what have the definition of collateral. Okay. So
what's the perfect debt to income percentage? Like, what would you say the perfect one is?
there isn't one. And the reason I say that, Jason, is simply because everybody is different. I know people somebody that has we'll talk about this a little bit more. You guys really don't, we wouldn't necessarily cover VA loans, but since we're doing this as a general thing, talk about that. With a VA loan, for instance, they don't necessarily look at debt to income. They look at what you have left over after you paid all your bills. So I actually had a loan approved for a plastic surgeon in Provo, and his debt to income ratio was almost 70%. Okay, when you compared took all his bills and the house and everything else, but his residual income left over after paying everything was over $25,000 a month. Okay, so he could have a huge debt to income ratio and still have $25,000 left over put in the bank every month, right? If you were talking about somebody who's making a lot less than that, a 35% debt to income ratio might be stretching them to the limit. Okay, when you consider what everything else costs, a cell phone bill for them is a lot higher percentage of their income than it is for that doctor. You know what I'm saying? So there really isn't. We will cover sort of what they talk about or what they accept on different loan programs, but it really comes down to what you are comfortable with, which is why that's why I talk to people about their whole overall financial picture when I'm doing a loan. Because there's, it just makes, it really depends on that person. So, next one. Okay, so there's your collateral. The value is going to be determined by an appraisal, which is done by a third party. We'd have nothing to do with the appraisal other than when somebody goes under contract to buy a house and we're doing all the other underwriting, all that kind of stuff, we order the appraisal as the lender. But it's done by someone else, okay, a third party. And that's simply because, and we have no control of it. In fact, we don't even see the appraisal until after it's done. We don't even know who the appraiser is until after it's done. And that keeps us separate from that. So we have no ability to influence what that value comes out as. Okay. That was an actual issue. It's part of the reason, part of the things that caused the crash back in 2008, when all the values crashed, were loan officers, real estate agents, and appraisers going in together and, you know, basically artificially inflating prices and things like that. Okay. Basically lying on appraisals. And that was one of the laws that was changed for the better, that you cannot, you know, you cannot talk to the appraiser. In fact, if we want to ask, most appraisals are done through what's called an appraisal management service. And if we want to have a reconsideration of value, say it comes in lower than we thought it was going to, you're buying a house for, and I'll use this about, you know, the lender, you know, where it says lender will lend on the lower the purchase price or appraised value. Say you're buying a house for $500,000, to choose round numbers, okay, and you're going to put 10% down. You've saved up for a few years, you're going to put 10% down. And so we have everything going. We're underwriting file. We send out for the appraisal, and it comes back, and it comes in at $490,000. Okay, the lender is going to assume that appraisal's is accurate. Okay, and they're going to assume that is the value of the house. So if you want to continue to buy that house, that's why you use a good real estate agent always. And I'm not talking about homie here. I'm talking about an actual real estate agent, where they can go in and negotiate with the seller's agent for you, okay, and figure out if they will drop that down to 490, okay, because if they don't, if you want to still buy that house, you're going to have to come in with $10,000 on top of your down payment to make up the difference, because that lender, you know, maybe you don't quite bring in 10% and use some of that money, but the lender is going to say, sorry, the house is worth 490, okay, so we're going to lend on that, okay, and then if you want to may buy it, so sometimes it comes in low. You know, there's negotiations, and maybe they drop it to 495 or something like that. So I have to come in with 5,000. But that's, you know, that's what the appraisal is there for, is to determine the value of the house. If you have a good real estate agent, that doesn't happen very often, you know, but it can. Okay. And so we just talked about that. If it's higher, then if the appraisal is higher than the agreed upon purchase price, well, you know what? Sometimes I'll get sellers agents calling me up and saying, "Hey, what did the appraisal come in at?" And what I tell people as the working for the borrower is, "Oh, it came in at value. If it comes in high, it came in at value. We're good," because it's none of their darn business that you just walked in. Say it came in at $510,000 on that $500,000 purchase. You just walked into this house with $10,000 instant equity, but it's none of their business. We don't. They can't go back and then say, "Oh, well, I want 510,000 for the house now." Okay. If I'm the loan officer, they'll never know what the appraisal came in at. Okay, and they shouldn't. It's not their business. Okay.
Cool. So now there's some words and terms, right, that we'll use a lot. And we've already used some of them already. But so we'll just kind of do a quick overview of some of them to kind of help you understand a little more. So first one is assets. And when we talk about assets, really we're just talking about the money that you have and most of the time the lender they'll ask you about your assets and what you have to determine if you have enough money for the down payment and closing costs and things like that. So they'll look at assets, obviously can be like your savings account, your bank account, what's in your bank, but also if you have like a 401k that you can draw off of to help pay for your down payment, those are things. And so they'll look at those different kinds of assets that you have and determine whether you have enough money to pay for your down payment and your closing costs. So that's one thing. The other is the actual down payment, right? And I think that's a pretty general term that a lot of people know about, right? It's how much money you bring up front to the table. It's kind of like almost like a good faith sort of thing to the lender that's saying you've got some skin in the game. It's not just, there are some loans you can get 100% financing in specific scenarios, but for the most part, you'll have to bring some sort of down payment to show the lender that, like, yes, I have some money, I want to buy this property, I have some skin in the game. So. And then cash to close is similar to down payment, in meaning, so it's your cash to close is your total, including your down payment. It's also your closing costs, which include things like, the appraisal fee, underwriting fees from the lender, their lender fees, and then your prepaid interest, all these things that go into it's really the amount of money that you need to bring to the table, to the closing table, to be able to close on your house. So it's your down payment plus your closing costs. So that's your cash to close.
Okay. Income. Here's one of the things that people need to understand about qualifying for a house. We're going to look at not only what you make, but what type of income it is. Okay. Hourly, salary, commission, overtime, bonuses. Now, salary is the easiest. If we're dealing with somebody they come into us and say, oh, I have a salary of $85,000 a year. Great. Let's divide that by 12 and there's your gross monthly income. Easy. Okay. However, if it's hourly, we're going to look at a couple things. We're going to look at it and say, okay, do you work full time? Do you always have 40 hours a week? Now, according to the IRS rules, full time is only 30 hours a week, but not according to lending rules. Lending rules is 40 hours a week. And if you don't have 40 hours a week, a lot of lenders are going to want to look at a complete 2-year history, even changing jobs and stuff, because they want to see what you've done and what you've averaged. Now, sometimes we can get them to say, okay, yeah, they work this many hours and this is what they make hourly right now, and use that as your income. Commission, it's a little bit different thing here, because most loans, not all of them, but most conventional loans are going to require a 2-year history of commissions. Okay. We can do FHA loans that will, 1 year, or if you move from one job that was salary or hourly and you work but you go in the same line of work and now it becomes commission. If you've been doing that for a certain amount of years beforehand and you have a proven track record of being able to do the job, then we can usually do it after 1 year too. Overtime and bonuses, typically, in order to count any overtime or any bonuses, you have to have a 2-year history of that. And we average those 2 years. Okay. So a lot of times, even though we get check stubs and those types of things, we might ask for things like, okay, you have bonuses for the last 2 years, and those are shown on your paycheck stub as bonuses. Well, get me your last paycheck stub from 2021, get me your last paycheck stub from 2022. So we can look at the bonuses at the end of the year in each one and then divide and average that over 2 years. Okay. And so it's the same thing with overtime. Okay. Interest rate versus annual percentage rate. You're going to see two numbers on any loan documents. One is going to be your interest rate, and that's what the payment is based on. Okay. There's a financial, you can get a financial calculator. In fact, I suggest you do, to figure out, things that are easy. If you're ever looking at a house and say, oh, I wonder what this would cost at whatever interest rate. You put in the loan term, like if it's 30 years, 360 months, and you put in the amount of what the loan is going to be. You put in the interest rate and you hit boom, payment, and it tells you what that monthly payment is going to be. Okay. The annual percentage rate actually brings in the costs, and it's a mathematical equation also that brings into the costs of doing the loan. Okay. And it lets you compare costs between lenders. Now, I will tell you this, and this is something that most lenders will not tell you, because this is what you're told. Everybody's told this. So this is one of those secrets that I talked about certified mortgage advisor. This is what people will not tell you that are typical loan officers. They'll say, oh, just look at this. Here are my terms, and we both have the same rates, and look, my APR is lower. Okay. Well, great. Do you know how long I'm going to live in that house? Because an APR takes in consideration what the cost will be if you were to go move into the house and have just that loan and pay every monthly payment on time, exactly what it's supposed to be for that loan term. That's, and then that's your APR. Well, that's not accurate if you move in 5 years. That's not accurate if you do this. So, somebody can say, I've got the lowest APR, I've got this. Well, they might not giving you the right deal or the right mortgage because they haven't asked the right questions about how long you're going to stay in a house and things like that. Okay. So just move on. So that loan term is just how many years, 30-year, 15-year, 20-year, 25-year. We actually have lenders that'll do whatever amount of years you want. You want a 27-year mortgage? Okay, here you go. Not all lenders will do that, but some will.
Loan to value we talked about before. It's the but the way that it's calculated, again, what we just talked about was it's either the appraisal or the sales price, whatever is lower. So when your loan to value comes to, when you're talking about it with in regards to like getting a loan, like an FHA, you have to put 3.5% now, which means your loan to value needs to be 96.5%, meaning that your loan is 96.5% of the value of the house. The value being, again, the lower of the sales price or the purchase price, the appraisal or the sales price, right? So your loan to value is, different for different kind of loan types. Some are 100%. They'll let you get a loan that's 100% of the value of the home, and conventional, you could do a 97%, a 3% down. So that's, loan to value is
The loan to
calculated
value
that
is
way.
just it's a division problem.
Yeah.
Here's your loan, here's the value you're using, boom, there's your answer. That's all the loan to value is.
So, and then escrows is one that, it's probably a weird word. I remember when I first heard it, I was like super confused. But really, escrow just means to hold back, right? So I think of it sort of like a safe that your money is being put into, because when it comes to things like your insurance, your homeowner's insurance, and your taxes, your property taxes are paid annually, but instead of getting a big tax bill on your property that's a couple $1,000s come November when it's due, instead of getting that, it's broken up into monthly payments, and that is added to your mortgage. But instead of being paid 12 times over a year to the state or the county or whatever, it's put into an escrow account and held for you, and the title company has a part in that. But it's put into that, and it's held until come November when property taxes are due, and then the money's taken out of that. So instead of, again, having one big bill, you pay into it every month.
The same with homeowners insurance. You'll pay 1/12 of that with your payment, and then it's paid, the month that it's due. The lender, the loan servicer, whoever you're making your payments to, will send that to your insurance company, will send the taxes to the county to have those paid. So you don't have to worry about it.
And we talked about the
Talk
appraisal,
about appraisal,
right? So
yeah. Title. When you buy a house, you close at a title firm in the state of Utah. Okay. Now, what does title to a house mean? Well, what they're looking at, we're going to talk about the title company, right? When you take title of something, you take possession of something. But we have title companies. You might have seen title companies around, Metro Title, what some of the others, Josh. We've got
Cottonwood Title,
whatever. You see them all over Utah County. Okay. Well, what they're going to do is there's a type of insurance when you buy a house, and it's called title insurance. And what they're doing is they're checking for liens on the property. Say somebody owned the property before, and they hired a contractor to do some work, and they never paid the contractor. Work got done, they never paid the contractor. That contractor can go put a lien on the property, so that when it's sold, they get their money. But sometimes those things slip through the cracks. So when you buy a house in Utah, title insurance is required. And you buy what's called a lender policy to protect the lender. And then the seller in Utah buys what's called an owner's policy to protect you. Okay. And that's part of your closing cost, part of the cost of doing a loan in Utah. And that title insurance basically protects you if in case there is a lien that got missed and somebody tries to collect it from you, the new owner. The title insurance pays for that instead of you having to pay that out of pocket. Okay. So. Okay, loan types, fun stuff. Okay, conventional loan is basically a loan where the lender is the rules are made by what we call Fannie Mae and Freddie Mac. They make the underwriting rules and everything. Have you guys ever heard of those two terms, Fannie Mae and Freddie Mac? They're just quasi-governmental agencies that make the rules when it comes to lending. That's all they are. Okay, and so they make those rules, and they basically they are when we're doing underwriting and stuff, we actually have to choose what we're going to use when it comes to conventional loan or even an FHA loan. We're going to use one of the two types of underwriting, and Fannie Mae and Freddie Mac have different rules sometimes. Okay, so keep going. Debt to income ratio, you can go up to 50% on this, but that's your total debt to income ratio, not just your house. That's everything. 50% of your gross. Now, just because you can doesn't mean it'll be allowed. The higher your credit score, the more responsible you've been, with your credit, the closer up to that 50% they're going to allow. And that is not necessarily what, you'll find what they call manual underwriting that doesn't allow you to go up to this. But there are computer programs that have all of the rules inputted, and they take your credit score, they take your income, they take a whole bunch of things into consideration, and then we put the information in there and say this is the loan amount we want, and it will allow us to go up to 50%. Okay, with some conventional loan types. Okay. As far as down payment goes, there's programs with as little as 3% down payment. Things that are called Home Ready and Home Possible that have income limits as well. Home One, and then that's basically if you're a first-time home buyer, there's no income limit, but you have to be a first-time home buyer, and the rate's a little bit higher than the Home Ready and Home Possible. And then there's programs called Borrow Smart, where they'll actually give you a little bit of money towards your closing costs. Typically, right now it's like $1,200. Okay,
But that has income limits. So it's like if you make a certain amount, like they'll give you a certain amount based on it's like $1,200, $2,500, depending on how much you make for the income limits that they have set for your geographical area.
Yeah, those income limits are set by by geography where you live.
Yeah. So
less than 20% down, you're gonna have something called mortgage insurance. Jason, you have any idea what mortgage insurance is?
Yeah, it's an extra fee you pay to somebody because you pay to the bank, or I guess probably whoever has your loan, for basically them taking a risk on you, not having a whole lot of money.
Yeah, not having the amount because it used to be. I'm gonna give you the spiel that I tell most people. By raise of hand, who has watched It's a Wonderful Life? Christmas movie. You've never seen it, Caitlin? Okay, all right. So It's a Wonderful Life. You've got the Bailey family, right? And you've got old Scroogey Mr. Potter, and he wants to keep, put the Potter family business out of business. Okay, anybody know why? What did the Potters do? I'll answer that. They had what was called a building and loan. They helped people save and then lent the money to build their own houses. This is to we're in an era here where most people, only really rich people owned housing. And even if you had suburbs and stuff, but most people lived in apartments. Okay, they live in houses. Most people live in apartments. And so Mr. Potter, he owns all these apartments. He wants people to keep renting from him to keep him being, rich. But during that time, if you didn't have 20% down, you didn't buy a house. So the government came up with these programs, VA loans where you don't have to put any money down if you're a veteran. FHA loans originally, you had a very small percentage down. But the lenders said, hey, we'll do those loans, but we're going to make sure that if somebody defaults, we want to be insured against that. So you're buying an insurance policy in case you default. You're paying for the insurance policy in case you default. And so people say, well, that sucks. Why do I want to do that? Well, if you weren't, then your interest rate would be a heck of a lot higher because they would be taking more risk on. So what they do is they actually take percentages and say, okay, if the more money you put down, if you only put 5% down or 3% down, you have one level of mortgage insurance based on a percentage. If you put 5% down, that in mortgage insurance is going to be a little less. It's always based on a percentage. 10% down, a little less, 15% down, a little less. And it goes that from an increment from 3% then to 5%, but then it goes by 5% marks. Okay. So if you were able to put 10% down, your mortgage insurance will be less than if you could only put 9.99% down. Okay. If you could just go to that next 5% mark, your mortgage insurance percentage will go down. And the good thing about conventional is once you hit 80%, okay, loan to value, and that's based on your purchase price. Some lenders will let you say if values have gone up, they'll let you have the privilege of paying for a new appraisal to see if you have 20%. Okay. But typically what the rule is, it goes off of what your purchase price was. And once you've paid down 20% of that loan amount, you can petition to have them remove it. They don't have to. If your payment history has been sketchy, for instance, they can say, no, we still don't trust you. You've been making the payments. It's been 20%, but you've had this many lates and da 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 da. Now, once you get to 78%, you have 22% equity from the purchase price, then it is dropped off automatically. Okay. So that's basically what, do we have anything else on? Okay. So let's go to the next one.
Next one is FHA. So that's probably one that you guys have heard a lot about. It is targeted towards first-time home buyers, but you don't have to be a first-time home buyer. It's just that you can only have one FHA loan at a time. So FHA has a little bit more, and because the FHA is the Federal Housing Administration, right? They have, it's a government loan, it's a government program, and so they have allowed lenders to offer mortgages to people with less, a little more risk, right?
Less stellar credit.
Less stellar credit, right? Things like that. And then the lower 3.5% down. So they've allowed these lenders to, do these types of loans, but there are some drawbacks that kind of come with that. So the DTI, again, it's a little more liberal, right? So you can go up to a 56.99. But that's, depending on your situation, really, again, you probably don't want to be above 50% for FHA, but they will allow you to go up a little bit higher.
Why does it say 46.99 and 56.99? Basically, what they're talking about there is your housing, your mortgage payment, including HOA, everything like that, can't go above 46.99. And then all of your debt can't go above 56.99. So they look at two different, that's what they call the top and the bottom debt to income ratios. The top is just your housing, and then the bottom is your housing plus every other debt.
So again, the down payment you can do as little as 3.5%. This one has, with an FHA, you have an upfront mortgage insurance premium is what it's called. And you can finance that into your loan, but it's a pretty sizable chunk. What's the percentage now?
1.75%. So here's the issue with this one. On the upfront mortgage insurance, you have two different types of mortgage insurance with an FHA loan. Okay, you have your monthly that's based on a percentage, and it's 85 basis points or 0.85% of your loan balance, and then divided by 12. Okay, is your monthly. They recalculate it every year. Whatever your balance is on the anniversary of your loan, they're going to take that 0.85% and multiply that by your loan balance, and you're going to pay that over 12 chunks once a month. But they also have an upfront mortgage insurance. I think it's sort of funny. So what they do is they make you put 3.5% down, but then they take your loan amount and multiply it, take 1.75% of your loan amount and add that back in. So you're financing more than your loan amount. Okay. And they call that their upfront mortgage insurance. And that can go up and down depending on how well financed the Federal Housing Administration is. I've seen it at 1%, and I've seen it at 1.5%. It's 1.75% right now. And that's because that happened when the housing crash happened. They lost money hand over fist, and so they had to increase those. Okay. And they increased the monthly as well. And so there's two parts of that mortgage insurance. Like Josh said, the upfront can be financed into the loan. It just becomes part of your principal and interest payment.
And then, so remember we were talking about with conventional, if you hit 80%, you've paid off 20% of your loan, you can get your mortgage insurance removed. With an FHA loan, it's permanent. It stays on your loan. That's why when we do FHA loans, we typically want to refinance people out of an FHA and get them into a conventional product, because the mortgage insurance on an FHA is higher. The mortgage insurance rate is higher than a conventional loan, and it's permanent. It doesn't go away. Even if you hit 78%, it doesn't get automatically removed. It continues for the life of the loan.
It used to, but now it does, and now it doesn't. They changed that after the housing crisis as well.
Right.
And here's the issue with that. The question might be, why would I ever do an FHA loan then? Well, one of the things that is a benefit of an FHA loan is your rate doesn't change all that much for a lower credit score. Okay. With a conventional loan, if your credit score is below 700, below 680, 660, whatever, you're going to take a hit in interest rate for every 20-point tier you go down in credit score. With the FHA, if you're above 640, you're pretty much okay. You're gonna get, even the rate might cost you a little bit more for the same rate as somebody in a 740 score, but the rate, you can get the same rate as somebody with a 700 plus credit score. Okay, so.
All right. USDA is another really popular one here in Utah, especially because areas like Eagle Mountain are still technically USDA eligible, parts of Saratoga Springs, I think.
All of Saratoga
All
Springs.
Saratoga Springs. And then south of pretty much Payson and
Yeah,
south.
basically south of Spanish Fork.
Yeah.
Spanish Fork is not eligible. And when you look at the populations of Saratoga Springs and Eagle Mountain, you would think USDA is what they call the rural housing loan, because USDA is the United States Department of Agriculture. So you would think, hey, we're going to have, as far as this USDA loan, we're going to be out in those rural areas. Well, this Cedar Valley, for instance, used to be a really rural area. And so that's basically part of what they call the farm bill that's only done once every 10 years. Okay, so if they say when they sign the farm bill, and one of these days someone's going to ask me when they did the last one, so I'm going to have to look that up because I can't remember.
It's been a while.
But next time they redo the farm bill, they might not. Eagle Mountain might not be part of the rural housing eligible area anymore. But it's a great loan. It's a great loan because the one thing about it's lower DTI. They only go up to about 43% maximum, and that's all of your debt to income ratio. The housing, they'll only go up to about 32, 33. Okay, so you have to have a decent income in order to qualify for this 0 down loan. So keep going on there, because it is a 0% down payment. But it also has a funding fee. Okay, just like the FHA, but its funding fee is only 1% of the loan amount. It's actually 1.0101, but whatever. So it's a they finance that in also. So if you buy a house for $500,000, what you're going to be paying is actually $505,000.
That'll be a loan amount.
Okay, what your loan amount is going to be. And so somebody might ask, why would we do this with 0 down payment? Because the interest rates are about the same as the FHA. The fact they're usually right exactly the same as the FHA loan. Okay. And if you can put 3.5% down, why wouldn't you? Well, I'll tell you why. Hit the next one. Okay. We got the rural eligibility funding fee. The income limits. I thought I might bring up the other one as far as the annual mortgage insurance, so the one that we divide by 12 and you pay monthly. It's only 0.35%. Remember what the percentage was for FHA? I just mentioned it briefly. It's 0.85%. So it's less than half the monthly mortgage insurance. Okay. So even if you're not putting 0 down and you have a higher loan amount, it doesn't matter what the numbers are. If you can do a USDA loan and qualify for it, you're going to have a lower payment than you would doing an FHA loan if you find a house in a rural area that qualifies. The other issue is income limits. A family from 1 to 4, that's the income limit. And here, what they do with the income limits is it doesn't matter. Say you have a husband and wife, and they both work, but they only want the husband on the loan. If USDA is going to say, sorry, we need to know what the wife makes as well. Because the income limit basically is all income by anybody 18 and over, okay? Unless you're a student. If you're in school and stuff, that's not necessarily going to count your income. But if you're 18 and older and living in a house, basically we've got to count your income against that income limit, okay? And then we're going to take the income of whoever's on the loan to determine the debt to income ratio. So you've got to be in sort of this tight little window of I don't make too much money, but I make enough money to qualify with the low debt to income ratios that are allowed on USDA. Okay.
Cool. VA loan is another government loan, but it's obviously only for qualified military personnel. And you can do we'll do a check when you apply. You have to have what's called a certificate of eligibility that the VA will give you that tells you when you get eligible for like other VA benefits and things like that as well. So but again, it's not based on debt to income. We kind of mentioned it before. It's based on residual income. So there's a calculator that we put in all of your monthly expenses, your debts and everything as well. They'll also take into account your taxes. So they kind of go off of your net income. And then they also take into account like utility costs and things like that. They have a calculation for like per square foot. of the house that you're looking for, things like that. And then they'll look at how much money you will have left over every month, and it has to be above a certain amount
For family size.
and it's based
You
on
know,
family size and area.
Jason, when I was talking about that plastic surgeon in Provo that had a debt to income ratio of over 65%, it's close to 70%, it was a VA loan. He couldn't have qualified for any other loan with that debt to income ratio. But with the VA loan, because he had that residual income, we were allowed to get to do the loan for him.
And again, it's a zero down, right? Just like USDA, it's a zero down loan, but VA loans don't have any monthly mortgage insurance. That's another benefit of, being a veteran, and just one of the benefits of a VA loan. So they are fantastic loans if you're a veteran, and that's like the number one loan that we'll try and qualify for, and it's pretty easy to qualify for as well.
There's a lot of military personnel around here, so.
Yep.
And then the one thing bad about the VA loan though is the funding fee.
Yep.
Because we talked about the 1.75% with the FHA, the 1% with the USDA. Well, the funding fee for a VA loan is over 2%, depending on, basically it could be lower than that depending on if they are putting money down. There's a whole chart on what it is, but it's typically over 2%. And then if they use it a second time, that funding fee is 3.6% of the loan amount.
Yep.
So we're talking thousands of dollars. If you're doing a $500,000 loan, that funding fee is going to be over 15. So it's going to be close to $20,000 that they're adding on top of that, then financing in the loan.
Yep.
Okay.
But if you're disabled, if you have a disability rating, you can get, it's above what, 40%?
If you have a disability rating at least 10%.
10%. Yeah, you can get the funding fee cut or waived.
It's waived completely.
Waived completely, yeah. So
All right.
We're gonna run through this decently quick. So loan application is the first thing that you'll do, and you'll hear a lot of people say, like, they'll talk about pre-approval versus pre-qualification, and there is a difference, but the one that you really want when you're going to buy a home is a pre-approval, and that's when you have, again, filled out an application, you've talked to a loan officer, and you've submitted them all of your documentation, which includes like your W-2s, tax returns if you're self-employed, and your pay stubs, things like that. And we'll look at your financial situation, where you're at, and we will tell you what, at that current time, what you can qualify for as far as a purchase price, right? And then you'll take that to the real estate agent and go start shopping for a house, and then you'll eventually make an offer on that house.
Let me put something in here that I think is important. You are not, anytime we do a pre-approval letter, because that's what people want, real estate agents, they'll send people to us, or people come to us and say, how much can I qualify for? And what they're asking is, what purchase price can I go look for, right? Well, you're not qualifying for a purchase price or a loan amount. You're qualifying for a monthly payment. Remember, CDC, credit, debt to income, collateral, right? Well, that debt to income, that's what we're using. So we've got to look at the monthly payment. So that can be completely different. You might say, well, if the interest rates are the same, then whatever purchase price, you're still going to have this monthly payment. Well, the taxes could be different from one house to another, just being in a different neighborhood, being in a different city. Okay. The homeowner's insurance can be completely different depending on the zip code you look at. Okay. The other thing is, one home might have an HOA, one might not. So if you're paying $100 a month HOA, that means that's got to come out somewhere out of your maximum, monthly payment that we can qualify you for, and it's going to come out of the principal and interest portion. That means if you buy a house with an HOA, then what you can qualify for loan wise and loan amount wise is going to be less, because that HOA has to be calculated into the debt to income ratio. So you're not qualifying for a purchase price, even though that's what your realtors want to know. How much can they qualify for? Well, okay, they can qualify for $2,500 a month, right? Well, great. If you have a $200 a month HOA, then that's going to be different, so we'll keep on.
So now we've got we have a really good real estate agent that we work with. His name is Ryan Yee. He's up in the Salt Lake area. He's fantastic at what he does. And he gave us this video that we're going to share about. He goes over what's called earnest money, and then the deadlines. When you make an offer, you get an offer accepted on a house, and then you have what's called a purchase contract, and that purchase contract now lays out the deadlines of this
When
whole
things
process,
have to
you know,
happen.
when
yeah.
things have to be done. So let's see. Mhm. There we go.
Hey everybody, how's
It's loading.
it going? This is Ryan Yee with Rise Homes, powered by Prex, just your local realtor out here in the greater Salt Lake region. Just wanted to go through what earnest money is and the 4 deadline dates of the buying process. So let's just dive into it. What is earnest money? Earnest money is a deposit made to the seller from the buyer that shows good faith the buyer will be buying the home. It's important because it shows the seller that the buyer is serious, and in return of that, the seller will remove the property from the market to allow the buyer to proceed with the buying process. And the earnest money is deposited into a brokerage or title company into their trust account. So if you proceed to close on the home, the earnest money is credited back into the buyer's down payment and goes towards the home. If you do not close on the home and you want to cancel, it's typically refundable all the way up until the finance and appraisal deadline. If you pass that deadline, you will typically lose your earnest money. Let's move on to the 4 deadline dates of the closing process. You have disclosures, which is 3 to 7 days. Due diligence is 5 to 11 days. Finance and appraisal is roughly around 11 to 21 days. And closing is 12 to 35 days. Now let's go through the disclosure deadlines. Typically it's 3 to 7 days. I write mine typically at 3 days, and that's because I like to keep my deadlines tight, but it does depend on what the seller and buyer's needs are. This is when the seller will give all the information they have on the home to the buyer. They will disclose all that through the seller disclosures. It's also when the HOA documents are sent over. It includes CC&Rs, financials, budgets. It's also when the buyer will receive the seller policy, title policy insurance. And that's when they can see if there's any liens on the house or any issues with the title. It's at this time when the buyer can ask any questions and clarify any concerns that they have. They can also renegotiate at this point, and if they want to cancel, they typically can get their earnest money back without losing any of it. Next is the due diligence deadline. Due diligence is usually 5 to 11 days. I typically like to write it up as a 7-day deadline. It gives enough time for an inspector to get called out to inspect the property. They go through and make sure there's any safety concerns, any maintenance issues. They'll also give tips on how to maintain the home. This costs roughly about $500 depending on condo, townhouse, single family, square footage wise, bedroom, basement. Other tests that you can perform is radon, mess, sewage scope. Those typically take a little longer, so you might want to have additional days in there. It's at this point that the buyer can go and talk to the seller about any issues. They'll negotiate any repairs. They can also discount the sales price if they don't like it, or a combination of both. It's at this time, if they do want to cancel, they can cancel and get all their earnest money back without losing any of it. So next is a finance and appraisal deadline. Typically that's around 11 to 21 days, depending on the needs of the lender, buyer, and seller. I typically write it up as 21 days, which is the industry standard. This is a 2-part process. So it's when the buyer obtains approval from the lender that they are approved for the loan. The second part is when the lender sends out an appraiser to get the house appraised to make sure it meets or exceeds the purchase price. If it comes down below, this buyer might have to come out additional extra down payment to cover that difference. So that's why you can always renegotiate at this time if it comes down lower. And you can also back out if you cannot get approved for the loan. You can also back out if the loan terms are unfavorable. Let's say interest rates went up 2% and you cannot afford the mortgage anymore. It just gives you another out to get all your earnest money back prior to losing it. If you typically cancel a contract after the finance and appraisal deadline, then you most likely will lose your earnest. The last one is the closing deadline, settlement. This ranges between 12 to 35 days. Typically it's a 30-day close. It's shorter if maybe you're already pre-approved or you're doing a cash deal or just seller and buyer's needs, right? So there is 2 action items that take place on this. The buyer will go to the title company to sign all the documents, and then the buyer will pay the down payment and the closing costs. So this is in a form of a check or a wire transfer during, before, or after closing. And then once you close on the house, you will have another 2 parts actually. So you have funding and recording, and then you have possession. Funding and recording usually takes place the next day, next business day. So this is when the title, they receive all the funds and they disperse it through the lender to all the appropriate parties. And then it's also when title will tell the county to record the new ownership. And like I said, it's typically the next business day, but you can do a table funding. Table funding, if you go and close earlier on that day and you specify you want a table fund, you should be able to get your keys that day.
Now that concludes the earnest money and the 4 deadline dates of the buying process. Once again, my name is Ryan Yee from Rise Homes powered by Prex. Feel free to reach out to me if you have any questions about the buying process or if you're looking to buy or sell your next home. Have a blessed 2023. Take care, guys.
Ryan is a real estate agent that I've worked with for several years now. And there's some, there's agents that when you're been in business as long as I have, there's agents that I don't work with. Okay, that I've done 1 or 2 transactions and figure out that it's not somebody I would ever trust with one of my family members. Ryan is someone I would trust. So we're not selling anything on here, trying to get to work with Ryan, but there's a reason why we allowed him to do this video. And as we do these along the months, we're going to use different real estate agents. But you can be sure that they're going to be ones that we trust. So real estate purchase agreement, all those kind of things. I'm not going to go over that. Let's go as far as the process goes. Purchase contract, that's something you work with the real estate agent. The appraisal and title, we deal with that. We order the appraisal, we order the title insurance and all that. And basically what's happening is you submit all the documents. We get the application, you went and you find a house, you go into contract, your real estate agent sends us that contract, and we basically put your file together, but it's not Josh and I doing that. Okay. We have what's called a processor. And that processor in our company, it's either Amber or Nicole, they put the file together. They used to have to stack the file and put an actual paper file together that we'd send in an overnight box. It was just for mortgages. Okay. Now, obviously it's all electronic. There's a point and click and here, drag this document here, drag this document here, drag this document here. But they put that all together and they prepare it to be sent to the lender to be underwritten, that they're the actual ones that will be making the decision on your loan. Okay.
And when they do that, you'll get most of the time you'll get what's called, like 99% of the time you'll get a conditional approval, which really means you're approved if you meet certain conditions. And a lot of times it's needing further documentation about a situation, or what is the underwriter sees something and they're like, okay, I just need a little more information about this, about what's going on, so that they can give you a full approval, which is what happened next. And so that's conditional approval. That's the processor will work with you to continue to figure those out and fulfill those conditions. So once that happens, then you'll get what's called the clear to close, which is your final approval that the lender says, okay, you're good, now you can go ahead and go to, in Utah, go to the title company. In other states, you'll go through like
An
a
attorney.
settlement attorney, something like that. But in Utah, it's the title company. And you'll go to them, you'll go with the title agent, and you'll sit down, huge fat stack of papers, and you'll sign them, and they'll help you go through all that. And a lot of times the real estate agent will be there, we'll be there, your loan officer, to answer any final questions or whatever.
I would suggest that 6 months before you go to buy a house, you start doing wrists and hand exercises, you know?
Yeah.
Because I tell people all the time that my parents signed fewer papers to adopt me than people now have to sign to buy a house. So they sign fewer things to buy a human being than people have to do to buy a house now.
Yeah.
So.
And after that, once you got your settlement done, you've signed all your papers, and you work with your real estate agent to get the keys to your house. So that's the whole process. It's realistically, I mean, by the time you get pre-approved and you've worked with because the pre-approval, with us, typically, if you're depending on your situation, sometimes self-employed people have their tax return. I've seen tax returns that are 50 pages long, and they take a minute to go through. But if you're like a W-2 or a salaried employee, you can get a pre-approval from us in, same day. And from that to the time that you close on your house, obviously depends on how long it takes to shop and get it
What
off.
was Ryan saying? He typically writes them in 30 days.
Yeah.
That's unless he's working with me.
Yeah.
He didn't put that because he works with other lenders, obviously.
Yeah.
Right. But we typically will close a loan in 21 days or under.
Yeah.
And I've closed them. You can't legally close a loan in less than 7 days by law. Okay, just because the number of things that have to happen.
There are
as
waiting
far as
periods
waiting
and-
periods and things like that. And so you can't do the 7, but I've actually closed a loan in 8 days. Okay, so it doesn't happen all the time, but it can, and it just depends on, and that's why I suggest to people that they actually get fully pre-approved with their credit and finances before they actually go out and shop. Because then you can tell a lender, look, or a seller, your agent can tell the seller's agent, look, all we have to do is get the house appraised, and we're done. Okay, and during that time, we've already pre-approved you, so that's the smart thing to do. Just as a last, this is basically the end of it. We don't go to take any more of your time. But one of the things that we want you to do, and if you will do this, is, like I said, we're recording this for different people, we're probably sending this out to a dozen people, but we'd like to have more people live that we can talk to and be more engaged in everything. Not that you guys aren't engaging. I mean, seriously, I could see those Johns, big Jason, no, I'm kidding. But it's a lot of it. A lot of it's boring, dry stuff. We get that, but it's very important to understand what's going on, and we want people to know that, because it's like I said, you're not going to make a bigger purchase. And so we want people to know that, and we want people to have this information. So if you'll do us the great favor of sharing it with people and letting people know that it's out there when you see it, because we'll be advertising, like you said, we go into before we hit April, sometime in March, we'll be advertising, they'll be coming again. And so if you would share that with people, we would sure appreciate it. You guys have any questions about anything that you're just dying to know the answer to? We're good. We try and cover everything. So a lot of things are going to be, you will have answers or questions, and if they come up, just call me, call Josh, whatever, and we'll answer those questions for you. So, guys, oh yeah.
Sorry, I did have one. If we wanted to, like, just see where we're at by getting a pre-approval, do we should I just call Josh up and say, hey, run these numbers for me and see kind of where we're at? Is that bad to do too many times?
No, I mean, once you fill out an application, the application, in order to get something accurate, you've heard the term when it comes to computers, for instance, garbage in, garbage out, right? So if you want a real numbers, then you're going to want to fill out, at least the first time, fill out the application, let Josh, let Josh run the credit report, get the pay stubs, those types of things, so we can actually calculate your actual income and what the underwriter would count. But once you know that, you're going to know approximately what it is. And then you'll know, I mean, if your income goes up or down, your qualification goes up and down accordingly. So we'll know, but you'll want to do that at least one time. And then once we have that information, if we, 6 months down the road, you want to be qualified again, we just look at the old application and say, okay, just get this, must be updated paycheck stubs. You'll know whether or not your credit score is, about the same as it was. You'll know whether you had a late payment or if you have higher, debts on your credit cards, or if you paid some down, so yeah, you'll be able to figure that out if we're only doing one. And so it's not like you're going to be filling out a new application every time.
Yep.
So
Yeah, and that's not something you have to wait until right before you're ready to buy a house. I mean, I've talked with people before and they just want to see where they're at. I looked at it, told them how much they could get approved for now, and they're like, okay, cool, well, I'll probably call you in 6 months to a year, something like that. Okay,
it's
perfect.
better to know that information up front,
Yep.
A few months ahead of time, in case there is something that needs to be corrected on the credit report. That's, somebody reported an account that's not yours, for instance, so we need to take care of that. It's just different things,
Yep.
so you want to know ahead of time.
Yep. And even, when you do get a credit pull for an application, one credit pull, not going to make a huge difference on your credit score either. So
No,
not something to worry about.
basically, if you think about it, your credit score is going to be, it's not going to say, oh, your credit score is 722 minus 3 points because you had a credit inquiry. It's just going to come out whatever the score is,
Yep.
right?
It'll affect your score later, but not really, not a lot. So not something to worry about. But anyway, awesome.
Okay.
Appreciate you guys. Thank you.
Okay.
Thank you.
Thanks. We'll see you guys later.
Yeah.
See ya.